Picture this. It's a quiet Tuesday morning in Washington. Federal Reserve officials are sipping their coffee, reviewing economic data, preparing for another day of managing monetary policy. And then they see it. Gold just crossed a threshold that makes every central banker in the world sit up straight. Because what gold is doing right now isn't just a price move, it's a vote of no confidence. And the implications are staggering. Let me show you exactly what's happening, why it matters more than anything else in financial markets right now, and what this means for your wealth in the months ahead. Gold doesn't move like other assets. It doesn't respond to earnings reports or quarterly guidance. It responds to something much deeper, much more fundamental. It responds to trust, or more specifically, the erosion of trust. And right now, gold is screaming that trust in the Federal Reserve's ability to manage this economy is evaporating. Central banks around the world just purchased over 1,000 tons of gold in a single year. Think about that number. 1,000 tons. That's not retail investors buying coins. That's not hedge funds making tactical bets. That's the institutions that create money, the ones who print currency, the ones who are supposed to have faith in the system. They're buying gold at a pace we haven't seen in generations. Why would a central bank buy gold? They can print their own currency. They have unlimited balance sheets. They can create money with a keystroke. So why are they converting that money into a metal that pays no interest, generates no dividends, and just sits in a vault? Because they know something. They see what's coming, and they're preparing. The Federal Reserve has painted itself into a corner. They raised interest rates aggressively to fight inflation. They told us inflation was transitory. Then they told us they had the tools to control it. Then they told us they'd achieve a soft landing. The narrative kept changing, but one thing remained constant. Their credibility kept eroding, and gold noticed. When the Fed cut rates recently, gold didn't just tick higher. It exploded to all-time highs above $2,700 per ounce. That's not a normal reaction. That's not a typical correlation. That's the market saying, "We don't believe you anymore. We don't trust that you can control this. We're seeking safety." Here's what makes this moment so critical. The Federal Reserve is trapped between two impossible choices. If they keep rates high to fight inflation, they risk breaking something in the financial system. We've already seen regional banks collapse. We've seen commercial real estate implode. We've seen cracks forming in credit markets. How much more can the system take? But if they cut rates to support the economy, they risk reigniting inflation. They risk destroying the dollar's purchasing power. They risk validating every gold bug who's been warning about currency debasement for decades. Either path leads to the same destination, a weaker dollar and higher gold prices. Let me take you back to a moment in history that rhymes with today. 1971. President Nixon closes the gold window. The dollar is no longer backed by gold. It becomes a pure fiat currency, backed by nothing but faith in the U.S. government. At the time, gold was $35 per ounce. What happened next? Gold went on a historic run. By 1980, it hit $850. That's a 2,400% increase in less than a decade. Not because gold became more valuable, because the dollar became less trustworthy. We're seeing echoes of that moment right now. The difference is the scale. In 1971, U.S. debt was manageable. The deficit was a concern, but not a crisis. Today, we're sitting on $36 trillion in national debt. The interest payments alone are over $1 trillion per year. That's more than we spend on defense, more than we spend on Medicare. We're paying more to service our debt than we're investing in our future. How do you solve that problem? You can't tax your way out of it. You can't grow your way out of it. There's only one path that's politically feasible. You inflate your way out of it. You devalue the currency. You make the debt worth less in real terms by making the dollars worth less. And that's exactly what gold is pricing in right now. The smart money sees this. That's why central banks are accumulating. That's why sovereign wealth funds are diversifying out of dollars. That's why institutional investors are adding gold exposure at levels we haven't seen since the financial crisis. But here's where it gets really interesting. The gold market isn't like the stock market. It's not deep and liquid with unlimited supply. The total value of all the gold ever mined in human history is around $15 trillion. That sounds like a lot until you realize the US stock market alone is worth over 50 trillion. The bond market is over 50 trillion. Global real estate is hundreds of trillions. What happens when even a small percentage of that capital decides it wants to own gold? What happens when pension funds, insurance companies, and sovereign wealth funds all try to increase their gold allocation at the same time? Supply and demand takes over, and the supply of gold is fixed. We mine about 3,000 tons per year globally. That's it. You can't just produce more because the price goes up. It takes years to develop a mine. It takes billions in capital investment. The supply is inelastic. Meanwhile, demand is accelerating. Central banks are buying. Retail investors in Asia are buying. Western institutions are finally waking up and buying. And the paper gold market, the futures and derivatives that have suppressed prices for years, is starting to crack under the pressure. Let me explain how the paper gold market works, because this is crucial to understanding what's about to happen. Most gold trading doesn't involve physical metal. It's contracts, derivatives, promises to deliver gold at some future date. The COMEX, the major gold futures exchange, has a tiny fraction of physical gold compared to the paper claims against it. It's a fractional reserve system, just like banking. This works fine as long as everyone plays along, as long as most contracts are settled in cash rather than physical delivery. But what happens when people start demanding physical metal? What happens when the paper market loses credibility? We're starting to see the answer. Premiums for physical gold are rising. Delivery delays are increasing. The spread between paper prices and physical prices is widening. These are the early warning signs of a market under stress. And here's the thing about market stress. It builds slowly, then breaks suddenly. Everything seems fine until it's not. The system appears stable until the moment it fractures. And when it does, the repricing is violent and swift. Think about what happened with silver in 2011. The Hunt brothers tried to corner the market. Prices exploded from $11 to $50 in a matter of months. The exchange changed the rules mid-game to break the squeeze. But even with rule changes and intervention, silver still trades multiples higher than it did before that episode. Now, imagine that scenario playing out in gold, but with central banks and sovereign nations as the buyers instead of a couple of billionaire brothers. You can't change the rules on China. You can't margin call the People's Bank of China. You can't force Saudi Arabia to sell. The geopolitical dimension of this cannot be overstated. We're watching the slow-motion de-dollarization of the global economy. Countries are settling trade in their own currencies. They're building alternative payment systems. They're reducing their dollar reserves and increasing their gold reserves. Why? Because they watched what happened when the U.S. weaponized the dollar, when Russian reserves were frozen, when sanctions became a primary tool of foreign policy. Every country in the world learned the same lesson. Dollar reserves can be confiscated, but gold in your vault cannot. This is driving a fundamental shift in how nations think about reserves. It's not about yield anymore. It's not about convenience. It's about sovereignty. It's about having an asset that can't be frozen, can't be sanctioned, can't be devalued by someone else's monetary policy. The BRICS nations are leading this charge. Brazil, Russia, India, China, South Africa, and now dozens of other countries joining or seeking to join. They're talking about a gold-backed trade currency. They're building infrastructure to bypass the dollar system. They're accumulating gold at unprecedented rates. China alone has been adding to its official gold reserves every single month, and those are just the official reserves they report. Most analysts believe their actual holdings are far higher. They're not buying gold to make a profit. They're buying gold to prepare for a new monetary system. India is doing the same thing. Their central bank has been a massive buyer, but even more significant is the retail demand. Indian households hold more gold than any other country. It's cultural, it's traditional, but it's also practical. They've lived through currency crises. They've seen governments confiscate wealth. They trust gold because it survived every crisis in human history. Now let's talk about what this means for you. Because this isn't just a macro story about central banks and geopolitics. This is about your purchasing power, your retirement, your ability to preserve wealth through what's coming. If you're sitting on cash, you're watching your purchasing power erode in real time. Official inflation numbers say 3 or 4%, But anyone who buys groceries, pays rent, or fills up their gas tank knows the real number is much higher. Your dollars are losing value every single day. If you're fully invested in stocks, you're exposed to a market that's priced for perfection. Valuations are stretched. Earnings growth is slowing. The Fed is trapped. One policy mistake, one credit event, one geopolitical shock, and we could see a correction that makes 2008 look mild. Bonds? You're locked into yields that don't keep pace with real inflation. And if rates have to go higher to fight inflation, bond prices will fall. If rates go lower because the economy breaks, the currency will weaken. Either way, you lose purchasing power. This is why gold is different. It's not about making a profit. It's about preserving what you have. It's about having an asset that maintains its value when everything else is losing value. It's about insurance against the exact scenario we're living through right now. Quick aside here because this is important. If you have $100,000 or more in retirement accounts, there's a way to get physical gold into those accounts without triggering taxes or penalties. It's called a gold IRA. I put together a free guide that explains exactly how it works, what the rules are, and how to set it up properly. It's in the description below. Worth checking out if you're thinking about protecting your retirement savings. No pressure, just information if it's relevant to your situation. All right, back to where this is headed next. Because the warning gold is sending isn't just about today, it's about what's coming in the next 12 to 24 months. The Federal Reserve is going to have to make a choice. They can maintain their hawkish stance, keep rates elevated, and watch the economy slide into recession. Or they can pivot, cut rates aggressively, and watch inflation reignite. There's no third option. There's no magical soft landing where everything works out perfectly. History tells us what they'll choose. Central banks always choose inflation over deflation. They always choose to devalue the currency rather than allow a deflationary collapse. It's politically easier. It's technically simpler. And it's what they've done every single time they've faced this choice. When they make that choice, when they pivot to aggressive rate cuts and renewed money printing, gold is going to explode higher. Not 10 or 20%. We're talking about a move that could take gold to $3,000, $4,000, maybe even $5,000 per ounce over the next few years. Sound crazy? Let's do the math. Gold hit $850 in 1980 when U.S. debt was less than $1 trillion. Today, debt is $36 trillion. If you adjust for the increase in debt alone, gold should be over $30,000 per ounce. Now, that's not a price prediction. That's just showing you how undervalued gold is relative to the expansion of the monetary base. Even if gold just catches up to where it should be based on money supply growth, we're looking at multiples higher from current levels, and that's before you factor in the supply constraints, the central bank buying, the geopolitical tensions, and the loss of faith in fiat currencies. The technical picture supports this too. Gold has broken out of a multi-year consolidation pattern. It's making new all-time highs. The trend is clearly established, and in markets, the trend is your friend until it's not. Right now, the trend in gold is unmistakably higher. But here's what most people miss. The real move in gold doesn't happen during the calm times. It happens during the crisis. It happens when everyone suddenly realizes they need it at the same time. When the paper market breaks. When physical premiums explode. When you can't get delivery at any price. We saw a preview of this during the pandemic. Premiums on gold coins and bars went to 20, 30, even 40% over spot price. Dealers were sold out. Mints couldn't keep up with demand. And that was just a temporary supply disruption. Imagine what happens during a real monetary crisis, when faith in the dollar truly breaks, when people are desperate to get out of paper assets and into something real, something tangible, something that's held value for 5,000 years. The people who wait until that moment to buy gold will pay prices that seem insane today. The people who position themselves now while gold is still available at reasonable premiums, while the market is still relatively calm, will look back on this as one of the best financial decisions they ever made. This isn't about timing the perfect entry. This isn't about trading in and out trying to catch every move. This is about recognizing a fundamental shift in the monetary system and positioning yourself accordingly. This is about understanding that we're living through a historic moment, a transition from one monetary era to another. The Federal Reserve's warning isn't coming from some press release or policy statement. It's coming from the market itself. It's coming from the price of gold screaming higher despite every attempt to suppress it. It's coming from central banks around the world voting with their reserves. It's coming from the breakdown of the post-World War II monetary order. You can ignore it. You can hope the Fed figures it out. You can trust that somehow this time will be different. Or you can look at history, look at the data, look at what's actually happening in markets right now, and make a decision to protect yourself. The choice is yours. But understand this. The window to act is closing, not because gold is going to disappear, but because the price you pay tomorrow will be higher than the price you pay today, because the premiums will be wider, because the availability will be tighter, because everyone else will have figured out what you're figuring out right now. Gold has been money for 5,000 years. It survived the fall of empires, the collapse of currencies, wars, depressions, and every crisis humanity has faced. The dollar has been the reserve currency for 80 years. Which one do you think will still be standing in another 80 years? The Federal Reserve can print dollars. They can manipulate interest rates. They can intervene in markets. But they can't print gold. They can't create trust out of thin air. And they can't stop the inevitable consequences of decades of monetary excess. Gold is sending a warning. The question is, are you listening? Because the game isn't over yet, but the final innings are playing out right now. And when the dust settles, when the monetary reset is complete, the people who held gold will be the ones who preserved their wealth. The people who trusted the system will be the ones wondering what happened. This is your moment to decide which side of that divide you want to be on. The evidence is clear. The trend is established. The fundamentals are overwhelming. Gold isn't just going higher. It's telling you that everything you thought you knew about money is about to change. And the smart money is already positioned for what comes next.